Welcome to the UAE E-Invoicing Framework Visual Summary. Prepared by PTG Consultant LLC, an FTA-accredited tax agent. Based on Cabinet Decision No. 106 of 2025 and the UAE Ministry of Finance E-Invoicing Guidelines of February 2026. Before we begin, here are the key numbers you need to know. There are over 50 mandatory data fields. There are 16 defined transaction use cases. The framework uses a 5-corner PEPPOL network. The official pilot goes live on the 1st of July, 2026. And for large businesses, compliance becomes mandatory from the 1st of January 2027. Section 1. What is UAE E-Invoicing? The UAE E-Invoicing Framework has 6 defining features. Feature 1. Electronic exchange in standard formats. Invoices must be created, exchanged, and reported electronically in machine-readable structured formats, specifically PINT AE or UBL 2.1 XML. Paper invoices and PDF documents will no longer be sufficient for in-scope transactions. Feature 2. Standardized data fields. The framework mandates over 50 mandatory fields as per the PINT AE standard, covering supplier and buyer details, VAT data, payment information, and 16 defined transaction use cases. Feature 3. Decentralized 5-corner model. Transmission happens via the PEPPOL network, which ensures interoperability between sellers, buyers, and the Federal Tax Authority through accredited access points. Feature 4. Phase-wise implementation. Phase 1 targets large B2B and B2G businesses with revenue of 50 million dirhams or more. Phase 2 will extend the requirement to small and medium businesses at a later date. Feature 5. Real-time invoice reporting to the FTA. Invoices are reported immediately upon issuance to the Federal Tax Authority via the Central Data Platform. Feature 6. Mandatory ASP appointment. Every business within scope must appoint an FTA-accredited service provider, known as an ASP, to validate and transmit their e-invoices. Section 2. Implementation timeline. The rollout follows a phased schedule. On the 1st of July 2026, the official pilot goes live. Selected organizations must complete their ASP onboarding by this date and begin transmitting e-invoices in the pilot program. From the 1st of January 2027, e-invoicing becomes mandatory for all businesses with annual revenue of 50 million dirhams or more. Voluntary early adopters may also go live from this date, provided they complete ASP onboarding by the 31st of July 2026. By the 31st of March 2027, all UAE government entities must be fully onboarded and live on the e-invoicing network. From 2027 onwards, the framework will extend to SMEs and additional business categories, with specific timelines to be confirmed by the FTA. Key deadline alert. Businesses with revenue of 50 million dirhams or more must appoint their ASP by the 31st of July 2026 and go live by the 1st of January 2027. Failure to meet this deadline attracts a penalty of 5,000 dirhams per month. Section 3. The PEPPOL 5-corner operating model. Understanding how e-invoices flow through the network is essential. The model has 5 corners. Corner 1 is the seller. The seller creates the invoice in their ERP or accounting system. Corner 2 is the sender access point. This is the seller's accredited service provider. It validates the invoice, converts it to UAE PINT compliant XML format, and transmits it via the PEPPOL network. Corner 3 is the receiver access point. This is the buyer's accredited service provider. It receives the validated PINT document and routes it to the buyer's system. Corner 4 is the buyer. The buyer receives the invoice directly into their ERP or accounting environment. Corner 5 is the FTA access point. The FTA receives tax data from both the sender and receiver access points, performs validation checks, and forwards the data to the central data platform. Two pieces of supporting infrastructure make this work. The Service Metadata Locator, or SML, is the central registry that routes messages to the correct access point. The Service Metadata Publisher, or SMP, is the company registry that publishes the capabilities of each access point. Importantly, status and rejection messages flow back to the seller from both the FTA access point and the receiver access point after validation. Section 4. Core Data Fields. Over 50 mandatory. The framework organizes its data requirements into 3 field types. Mandatory fields are required for every single invoice. These include the invoice number and date, invoice type code, currency code, transaction type code, seller and buyer legal names, tax registration numbers, addresses, VAT amounts, and document totals. Conditionally, mandatory fields are only required when specific transaction conditions apply. For example, a delivery country code is required for export transactions, and the buyer's tax registration number is required where the buyer is VAT registered. Optional fields support internal records and business context, such as purchase order references, contract references, and branch details. The 6 data categories are invoice information, seller information, buyer information, tax details, document totals, and line item details. An important note: 15 fields highlighted as mandatory under UAE PINT are not currently addressed in the UAE VAT law. Businesses should monitor regulatory updates for any legislative amendments. Section 5. The 16 UAE E-Invoicing use cases. Each use case builds on the 50 mandatory fields and may require additional data points. The common transaction scenarios are: Use Case 1. The UAE standard tax invoice for B2B and B2G transactions. Use Case 2. Reverse charge mechanism, where VAT is accounted for by the recipient. Use Case 3. Zero-rated supplies, such as qualifying healthcare. Use Case 4. Deemed supply, where VAT applies despite no direct consideration. Use Case 5. Standard credit note. Use Case 6. Summary tax invoice covering multiple smaller transactions. Use Case 7. Summary credit note. And Use Case 8. Simplified tax invoice for B2C transactions. The specific transaction scenarios are: Use Case 9. E-commerce supply through a marketplace platform. Use Case 10. Exports. Use Case 11. Margin scheme for used goods. Use Case 12. Disclosed agent billing. Use Case 13. Agent billing credit note. Use Case 14. Commercial invoice for export shipments. Use Case 15. Self-billing invoice where the recipient issues the invoice. And Use Case 16. Deemed supply invoice. Accurately identifying the relevant use case is critical because it determines which conditionally mandatory data fields must be completed. Section 6. Before and after e-invoicing. For a standard tax invoice in a B2B or B2G transaction, before e-invoicing a PDF or paper invoice was acceptable, with no structured data format required. After e-invoicing, the invoice must be in PINT AEXML format, transmitted via an accredited service provider, and reported in real time to the FTA. For a reverse charge transaction, before e-invoicing there was no standardized code or field required. After e-invoicing, the VAT category code, AE, must reflect the reverse charge treatment. A delivery country code becomes mandatory, and the buyer's tax registration number is required where the buyer is VAT registered. Section 7. Implementation Roadmap. 6 steps. Step 1 is the gap assessment. Map your ERP fields against the 50 mandatory fields. Identify missing and conditional requirements, and review your existing invoice templates. Step 2 is system setup. Update your ERP to capture all required data points. Configure lookup tables and standard codes, and establish validation rules for mandatory fields. Step 3 is data readiness. Contact your vendors and suppliers to close data gaps. Obtain electronic addresses and system identifiers, and gather tax registration number details from all counterparties. Step 4 is ASP onboarding. Select and finalize your accredited service provider. Integrate the ASP with your ERP environment, and test end-to-end invoice generation workflows. Step 5 is pilot testing. Choose one business unit or invoice scenario. Identify hidden data gaps and process weaknesses, and resolve system issues in a controlled setting. Step 6 is Go Live. Begin mandatory e-invoicing via the PEPPOL network. Ensure real-time tax data reporting to the FTA, and establish ongoing monitoring and compliance management. The advice from PTG consultant is clear. Start early. Plan methodically, and build a strong data foundation for a smooth e-invoicing rollout. Section 8. Business transaction scenarios. There are 6 key scenarios to understand. First, exports of goods or services. The supplier generates the e-invoice, validated by their ASP. However, the e-invoice is not transmitted to the buyer's access point. A standard ERP-generated PDF is sent to the overseas buyer instead. Second, import of services under the reverse charge mechanism. The buyer creates the RCM invoice, and the data is validated by their ASP and reported to the FTA. The e-invoice data is not transmitted to the overseas supplier. Third, self-billing or self-invoicing. Used for commission settlements, scrap purchases, and unregistered suppliers. The buyer prepares the self-invoice. A prior agreement between supplier and buyer is required, and the buyer is responsible for data accuracy. Fourth, third port shipments. Sales are treated as exports. Purchases may continue through regular PDF invoice recording in the ERP. Fifth, domestic purchases from vendors below the 50 million dirham threshold. These transactions are not reported through the e-invoicing network. However, VAT return reconciliation remains necessary for all transactions. Sixth, retail sales or services to individuals, meaning B2C. Simplified invoice rules apply, and businesses should monitor FTA guidance for specific B2C invoicing requirements. Section 9. Penalties for non-compliance. Under Cabinet Decision Number 106 of 2025. The following administrative penalties apply to persons within the mandatory e-invoicing scope. Failure to implement an e-invoicing system or appoint an ASP within the required timeframe. 5,000 dirhams per month. Applied for each month of delay. Failure to issue or transmit a required e-invoice on time. 100 dirhams per invoice. with a maximum monthly cap of 5,000 dirhams. Failure to issue or transmit a required electronic credit note on time. 100 dirhams per credit note, with the same monthly cap of 5,000 dirhams. Failure by the issuer to notify the FTA of a system failure within the required period. 1,000 dirhams per day. Failure by the recipient to notify the FTA of a system failure. 1,000 dirhams per day. Failure to update registered business details with the ASP or FTA, such as a tax registration number change. 1,000 dirhams per day. Note that voluntary adopters are excluded from these penalties. Section 10. Excluded transaction categories. Not all transactions fall within the e-invoicing scope. The following are currently excluded. Government sovereign activities, where there is no competition with the private sector. International passenger transport, where an electronic ticket has already been issued. Ancillary airline services supported by an electronic miscellaneous document. Airline cargo transport supported by an airway bill, which is excluded for 24 months from the e-invoicing effective date. Exempt or zero-rated financial services under Article 42 of the UAE VAT Executive Regulation, and any additional transactions that may be specified by the Minister through future decisions. Section 11. Key implementation challenges. On the operational side, there are 4 main challenges. First, submitted invoices cannot simply be cancelled. Any correction requires an electronic credit note linked to the original invoice, adding extra process steps. Second, rejected invoices can disrupt operations. Validation failures may delay deliveries and postpone revenue recognition until the data issue is corrected. Third, poor master data drives rejections. Incorrect tax registration numbers, outdated address records, and inconsistent product information significantly increase failed submissions. Fourth, multiple invoice sources increase complexity. Invoices from ERP systems, point-of-sale systems, platforms, billing tools, and spreadsheets make creating one consistent data stream a major challenge. On the governance and compliance side, there are 3 additional challenges. Unclear ownership creates risk. E-invoicing requires close coordination across tax, IT, finance, and operations. Unclear ownership leads to accountability gaps. E-invoice data will be compared with VAT returns. The FTA is expected to compare invoice-level reporting against periodic VAT return filings. Mismatches may result in increased scrutiny or audit attention. And archiving requirements are strict. Compliant e-invoices and credit notes must be stored digitally for the required retention period within the UAE, with appropriate security and accessibility controls. Section 12. Mitigation Roadmap. 4 practical actions address these challenges. Action 1. Start early and plan properly. Avoid a last-minute implementation rush that can create costly mistakes. Begin by analyzing current processes and dependencies well before the mandatory deadline. Action 2. Define standard operating procedures and train your team's document procedures for invoice issuance, rejection handling, electronic credit notes, and record retention. Train all relevant teams on their new responsibilities. Action 3. Select the right ASP partner. Look for strong pre-submission validation features, clear dashboards for exception handling, proven ERP integration capability, and strong local support expertise. Action 4. Run a pilot program. Choose one business unit or a specific invoice scenario for pilot testing. Use the pilot to identify hidden data gaps, process weaknesses, and system issues in a controlled setting. Section 13. Common misconceptions clarified. Misconception 1. E-invoicing only applies to VAT-registered businesses. This is incorrect. The framework is aimed at qualifying business transactions, not solely at VAT registration status. Non-VAT registered entities may still be in scope. Misconception 2. Free zone entities or non-VAT registered businesses are outside the e-invoicing scope. This is incorrect. The framework may still apply to free zone and non-registered entities where they participate in B2B or B2G transactions. Misconception 3. E-invoicing replaces the existing UAE VAT rules. This is incorrect. The VAT rules themselves do not change. E-invoicing changes the method of issuing, exchanging, and reporting invoice data, not the underlying tax obligations. Misconception 4. A capable ERP can transmit e-invoices directly without any intermediary. This is incorrect. E-invoices must be validated, exchanged, and reported through an FTA-accredited service provider. Direct transmission is not permitted. Misconception 5. The ASP handles VAT compliance for the business. This is incorrect. The ASP supports the technical process only. The business remains fully responsible for data accuracy and tax compliance obligations. Misconception 6. Record retention is no longer necessary once tax data is shared electronically. This is incorrect. Businesses must continue to maintain invoices and supporting documents for the required retention period, regardless of e-invoicing submission. Section 14. Invoice type code reference. For reference, the key invoice type codes are Code 380 for a commercial invoice, Code 381 for a credit note, Code 382 for a debit note or commission note, and Code 388 for a tax invoice or self-billed invoice. The VAT category codes are S for standard rate at 5%, AE for reverse charge where VAT is accounted by the recipient, Z for zero-rated supply, E for exempt from VAT, and O for outside scope of VAT. The payment method codes are 10 for cash, 30 for bank transfer, 48 for credit card, and 49 for direct debit. This visual summary is based on the PTG Consultant LLC presentation. UAE E-Invoicing Implementation. What every business needs to know. And the UAE Ministry of Finance Electronic Invoicing Guidelines of February 2026. Always verify against the latest FTA and Ministry of Finance guidance before making compliance decisions. Thank you for listening.